Okay, so let's start our last chapter for the first book, which is the behavioral finance. So, okay, in behavioral finance, we're going to first, at the macro level, going to understand what is behavioral finance and how does it differ from the traditional finance theories and practices, and what are the important things to remember. So, I've just tried to concise the entire chapter into things which are important for the exam. So, some of the pointers of traditional finance versus behavioral finance. So, traditional finance, the focus is on how the investors should ideally behave. This is the ideal scenario. This is on is the behavioral finance is actually retrospective. It is on actually how the people behave and they make decisions based on their behavior, not based on the theory of finance. Traditional finance assumes that people are rational, selfish, and risk averse. It believes that the rationally economic men, because of their rational and risk averse behavior, and a traditional finance based approach, it leads to an efficient market because it believes that investors are rationally behaving. They are behaving in terms of the laws of finance, like they are not buying overbought securities or expensive securities. They are keeping their money parked in good value stocks, not going for the growth stock. The stock market is looking stable. Hence, rationally economic men lead to an efficient market. That is the assumption. Over here, there is a word written which is normative analysis and perspective analysis. So, normative analysis, it assumes that because the investors are rationally economic men, so the portfolio allocation or the portfolio selection or the investment style is optimal. And perspective analysis means if it is not optimal, there are tools or measures which the investors can take in order to be normative. We compare this with the behavioral finance. The behavioral finance is based on biases, both emotional and cognitive. So when we say emotional, it is based on feelings. Cognitive means based on knowledge. So if the investor is behaving abruptly because he doesn't have that knowledge, it's a cognitive bias. But if the investor is behaving differently only because on the basis of his beliefs or only on the basis of his behavior, that comes as an emotional bias. Since it is emotional and it has some cognitive errors, obviously it will not lead to an optimal or efficient market, and there will be market anomalies. Over here, we saw that traditional finance leads to normative analysis, and if it is not normative, there is a way to use the tools and theories to get the allocation to a normative way. Over here, it is basically how actually people make decisions. It believes that the market value or the stock value or the portfolio value of an investor is basically because of the behavioral traits that they are showing. Okay, so based on the neoclassical theory and REM, there are four axioms of utility theory. Now we know what is utility theory from L1 and L2. That for a given dollar of investment, an investor will always seek for the maximum utility. He wants the maximum return for that $1 at a given level of risk. So that is the concept of utility. But over here, if you see, the utility function also has different, it behaves differently for different types of investors. So if an investor is risk neutral, he is indifferent what happens to the market or how much risk he's taking in the portfolio or how risky the market is looking like. His curve will be the utility curve will be on the indifferent curve, right? As in when his as in how his wealth is increasing, his utility also increases. But if it's a risk averse, then there is a diminishing, because as more and more and risk averse investor becomes wealthy, his utility decreases because he is a risk averse investor. He will not invest in risk in stocks. So as an more, when his wealth is increasing, he will look for a less riskier investments. And then obviously there is a risk seeking type of an investor. As and when his wealth increases, his utility also increases because he is a risk seeking investor, and he will look for investments which will give him better return than the risk free rate or the conventional market rate. Okay, so there are four items which are mentioned over here, and it is somehow, they are asked in the exams in the AM and PM section both. So there are four axioms of utility theory. One is completeness, transitivity, independence, and continuity. You can remember this as CTIC, or if you're having difficult to remember, just remember it as CTC, which is your part of this part of it's an acronym for your salary or whatever compensation that you get, and maybe then you can remember it as CTCI, or you can remember it as CTIC. So the agenda over here is basically, it is telling that as per the utility theory, a rationally economic man, a person who is behaving rationally in terms of his financial decisions and the market is efficient, they follow four things. One is completeness, they know their preference. So they know their preference, they know how the market is performing, what are the opportunities over there. Transitivity, they have a consistent rational behavior that so in case of a crisis, when the market falls, behavioral pattern shows that most of the investors will sell off their securities and their investment, and they liquidate their investors fearing more downside. But a logical explanation to that would be, since the market has crashed now, and historically the market has moved upwards in a longer term of frame of mind. So investors who are from a longer term perspective, they will show consistent rational behavior, and investors who are having a bias or an emotional bias, they will usually show a different behavior or a non-rational behavior. The decisions are independence, that is ranking is based on ranking for decision is making is additive. That means if you see in the example in the book, they have mentioned that if the combination of a plus a is over b is greater, then any combination of a plus b will be a plus c will be greater than b. So that way the decision making is additive. Doesn't really make sense in this chapter as such, this part, because they have not explained it in a financial context. They have explained it more from a probability context, but you just need to remember it for the exam, that there are four axioms, which is CTIC. The last one is continuity, wherein important thing is that the utility indifference curve is continuous. That means a rationally economic people or a group of people lead to a market which continues to look for an optimal uh, weightage of the portfolio. A rationally economic man applies a Bayes formula for decision making. Over here, I have kept a short word in bracket which is new info. So, what is the Bayes formula? Bayes formula is probability of A given B is equal to probability of B given A divided by probability of B and the whole multiplied by probability of A. This we are doing it from our junior college or maybe even school time. This is basically a probability mathematical function as to what will happen if X things happen. So usually what happens, investors, they have a view. Say I have a view that okay, Facebook is a very good stock. Let's accumulate it. But if the US Senate or the US security agencies, they apply some limits on Facebook, they try to curb their business, they try to put some competition laws. So these are some new information which has come from that security. But if I don't incorporate that information in my model or my thinking or my investment objective, then that is a problem, right? But what the author over here is saying, that a rational economic man will use a probability based calculation to adjust for new information and see what will be the impact on his probability based on the new information. In the book they have given a mathematical school kind of an example, but I believe they should have given a financial example that is much more easier to understand. The next is the utility versus prospect theory. Okay, so traditional finance is based on utility theory with an assumption of diminishing marginal utility. So, what is diminishing marginal utility? This is traditional finance. As the wealth increases, the utility decreases. So, traditional finance is based on utility theory. It leads to two consequences. First, the risk averse utility function is concave. We saw that in the previous screen. As more and more wealth is added, utility increases at a diminishing rate. We saw that in the last slide. As more and more wealth is added, the utility decreases or increases at a decreasing rate. Secondly, it leads to a convex indifference curve due to diminishing marginal rate of substitution. Honestly speaking, I don't know why they have mentioned it over here and not given a good explanation in the book. But from an economic kind of economic perspective, this is important to understand. Just to remember it as part of the exam, that the traditional finance is based on utility theory and it leads to two consequences: a concave curve for increased wealth, and the increased utility is at a decreased rate. So this leads to a concave curve. And then it says that it leads to a convex indifference curve due to diminishing marginal rate of substitution. So marginal rate of substitution is basically, uh, how do I explain you? So the marginal rate of substitution. So yeah, I had some technical issues. So marginal rate of substitution, diminishing marginal rate of substitution. So this is a concave curve, which you have explained. The first part. The convex curve is, it leads to a convex indifference curve. Convex indifference curve due to diminishing marginal rate of substitution. So from L1 and L2, we know that marginal rate of substitution is basically, exchanging one good for other, or consuming one good in place of other. That's a rate of substitution, marginal rate of. So as and when the wealth increases, the marginal rate of substitution, the willingness to do more substitution decreases, and that is why it leads to a diminishing marginal rate of substitution. So over here, the author has also mentioned about a decision theory. So it is basically, it gives you an history of how the entire, the different authors have defined that how investors make decisions in the last 2 3 centuries, how the general consensus of investors and uh, psychology of investment is. So decision theory, in short, it tells you about the willingness and ability to think rationally, mathematically, and act on information and data. It is basically, in case you want to make a good decision for your investment portfolio, he should be able to do, basic mathematics, should be rational, should be fully informed, and then only he can do a lot of simple investment calculations or project his investments. Why over here we have mentioned the word mathematically is because, in case if the investor is not capable of doing these kind of thinking or these kind of calculations and understand them, then he will show cognitive biases. So cognitive biases are those biases which are due to lack of information and knowledge. Then we also have a perspective theory. So perspective theory is basically more psychological based, more psychology based. In that, it tells you that how historical data is used to analyze how individuals make decisions. So obviously, when you're taking psychological thing, you will consider as the belief of the investor, the data that they're looking at, and also if they're applying any shortcuts, like mental shortcuts for decision making, right? So perspective theory is more for behavioral finance. It allows you to understand that whether an individual is making knowledgeful decision, or he's making educated guesses, or he is only just trying to get away from the situation by applying a shortcut. For an example, I can explain you that if you ask some investor that what is your view on gold, so he will just apply a shortcut saying, okay, a festive season is coming up, so gold should go up. So that's a shortcut that he has applied based on his belief and the historical experiences that he has had. But actually, what he should have done is he should have gone to the market, look at the data, look at what is going around, what is the macroeconomics, and then made his own decision. So that is more from a behavioral finance. Okay, so in behavioral finance, there is one important thing that comes across the entire chapter is the bounded rationality. It is basically it's the limited knowledge kind of a thing for an investor. So it assumes that investors behave with a bounded rationality. So if you have all the information and all the data that you want for investment, then you will become a rational investor, right? Fully rational investor. You have all the information. But if you are not willing to take the entire information, going on your own belief, looking for more value without putting that hard work, then you are going to have a limitation to your rationality, right? Your rationality will have some limits because you have not done your homework to understand the data and the investment process. That is why your rationality is bounded by your belief. That's what is known as bounded rationality. It makes it assumes that investors make decision based on the satisfaction that they get from the decision rather than the perfection. We'll take the same example. Like if an investor has invested just before a festive season in last 3 years, and he is able to get good returns, he is most likely to do the same thing in this year also, even if the macros have changed, even if the information has changed, because he is more satisfied with his own belief rather than actually looking at the perfection of his investment decision. And also, in the bounded rationality, one more feature is that individuals look for cost optimization. When we say cost optimization, is basically they want better return by taking lesser risk. So they want better return by taking lesser risk. So that is one of the part that is mentioned over here. In the prospect theory, it has two phases. So this is the prospect theory. We'll come to this again. What is prospect theory? So we'll come to that again. But just let me tell you two things. That this prospect theory and the utility will come across all the behavioral questions. So be prepared for it. We understood in the last slide that this is the utility curve. As the wealth increases, a risk neutral investor will have a straight line or an indifferent curve. A risk averse investor will have a diminishing marginal utility, and a risk seeking investor will have an increasing marginal utility. As and when he gets wealthier, he will look for more riskier options. This was the utility theory. Now the prospect theory says that, say I have invested in, say, a stock ABC, and initially in the first month I got around 10% return, right? So generally my behavior was, okay, it's good, it's 10% return, it's okay, yeah. But subsequently in the next month I got a 10% loss. Example, in the next month I have a 10% loss. Now, right now my behavior would be, oh no, my portfolio has gone by 10, down by 10%. So you see, for the same amount of profit and loss, an investor will show different behaviors. That is known as the prospect theory. They will have more pain for the losses rather than having happiness for the same amount of profit. This is the prospect theory, and it is very common. Even most of the well-known investors have faced this problem, and this is a psychological issue, not a cognitive error. It's a psychological issue. It's more. It gets better and better with experience. So that is the prospect theory. Okay, so prospect theory has two phases. One is the editing phase. So to remember, this is basically to these are the six steps in which you understand what is happening, and then you do an evaluation of your situation. So you can remember this. It's codification, combination, segregation, cancellation, simplification, and detection. So codification is basically identify whether this investment will be a profit or a loss. If there are multiple ideas or multiple investment theories which are pointing to the same thing, you combine them. At the end, when you have an expected return in place based on the step 1 and 2, you segregate them from a risk free rate and a risk premium rate, separation of data. Cancellation is removing of all duplicate outcomes. Simplification is basically rounding off a probability. Suppose someone says you have 53.5% of success. You can very well consider this as a 50% of success. You don't need to make the model complex. And detection of dominance is basically discard dominant proposals. So in case your probability outcome is showing you some dominant probabilities, you might as well discard them. The reason why you discard the dominant proposal is basically, if something is so sure, then or the probability is so high, that means either the data is not correct or the data is incomplete, and there's a very less likelihood that this kind of an probability will hold true. The next part we'll cover in another video, which is portfolio construction and behavior of capital market and other behavioral biases of individuals. Thank you.